What is going on, everybody? Happy Thursday, January 2nd, 2025, first trading session of the new year. Let me go ahead and make sure that everything is working right. And we'll go ahead and start. So today we're going to be talking about the strongest stocks that we can find right now in the market. But before, I want to preface this idea that potentially we're going to be trading into a different type of environment this year. I think this is going to be a completely different type of environment. I think that we're going to have to change the playbook coming into 2025. I do not think that it's going to be the exact same as it was in 2024. Very rarely is it the same. In back-to-back years in 2023, we saw realistically a majority of the profits came in through the Mag 7, right? We owned a bunch of the Mag 7. We held them for a long time. 2024 was a completely different playbook. We saw breadth finally expand. Lots of different areas of the market were working up until the very end of the year, where we saw a historic breakdown in market breadth. And in 2025, we're once again seeing the beginnings of a different playbook. And so it's important to understand where we are within this market cycle, both on a secular and a cyclical basis, and key in on any sort of clues we can take away from the end of December and into January on how we should be positioning ourselves into 2025 through Q1, right? So first things first, we have to call attention to the most important chart in the entire market, which is the dollar index, the DXY. Over the last 2.5 years, the dollar, almost 3 years now, every time the dollar starts to advance, stocks tend to catch a headwind, right? We've seen a lot of weakness come in across the broader market as the dollar started to break out in late 2024. That is absolutely not a coincidence. Every time the dollar seems to rip, stocks get hit. You have to think about it from a risk versus reward standpoint. The average investor, would you rather own dollars in an environment where potentially rates are rising, or would you rather own stocks? And every time the dollar starts to catch that bid, stocks start to get hit. Different areas of the market have been hit worse than others. We'll talk about that in a second. But realistically, key idea here is that as the dollar breaks out into new highs, which as of right now, this is a structural breakout after a 2+ year horizontal channel, you have to assume that the dollar is going to continue to rise here. We saw the beginnings of a potential bearish momentum, divergence here in the RSI. It is still technically on, but these things do not have to resolve lower, right? A divergence in momentum is simply supporting evidence of a potential incoming reversal. And in this case, I don't know if today is any indication, but it certainly doesn't look like the market wants to reverse the dollar here. As a matter of fact, we're at 109. We started the day in the 108s. Bear market highs up near 11450, excuse me. Is there a realistic chance that we hit bear market highs in the dollar this year? Well, if you're a trend trader, if you're a momentum trader, you have to assume that there absolutely is an opportunity for the dollar to continue to rip here. And so bigger question is, if the dollar continues to rip into 2025, what does the stock market look like? It's not going to be the same as it was in 2023 and 2024. In 2023 and 2024, we saw this nice horizontal channel formed in the dollar. It gave the market an opportunity to absolutely rip, right? We had back-to-back years of 20% plus moves in the S&P 500. The NASDAQ is up something like 75% in 2 years. It was an incredible 2-year run in the market. And while we expect 2025 to also be a bullish year, we do not expect it to have the same sort of vigor that it had in 2024 and 2023. And I think that if you're looking for supporting evidence of a potential, not necessarily bear market, but if you're looking for evidence that the market is going to at least slow down, the dollar has to be front and center, right? The dollar breaking out into new highs has to be the catalyst that sends everything kind of haywire. Okay, so at least in TTI, as the dollar is breaking out, we're taking this as evidence that we have to be a lot more selective with our process. We have to be a lot more aggressive with our positioning, with our entries, with our stop outs. This is not the year. For example, in 2024, we were able to hold trades. My average trade was 3 months long. My average stop out was 21 days. So I had a lot longer time frame on these trades because trends were stronger for a majority of 2024. In a market where the dollar is breaking out and we might see a lot more chop, a lot more volatility, it will be reasonable to expect that these average hold times both come down on an average winner, which once again was 3 months, and an average loser, which was 21 days. I would expect that those get shorter in 2025. Okay, so really quick, if you're a part of TTI, I sent out an article. I just want to show you guys one chart in particular because this has been the topic of discussion for a while. What happens when we have two 20+% years in a row? Well, most people expect that the next year has to be bearish, and the data does not support that whatsoever. I understand this is a small sample size, but going back to 1950 now gives us 75 years worth of data. So it's not a small amount of data here from a year standpoint. 75 years is plenty to at least extrapolate a general idea. And if we look at the last couple of times that we saw back-to-back 20% plus years, generally the next year is pretty okay. Is it always going to be as bullish as the previous 2 years? I would assume that it's not, right? We have some market forces coming in, particularly with the dollar, particularly with rates rising, that might come in and kind of kick down the expectancy of a continued 20% plus. You can see this grouping of 1990s, the dot-com bubble saw 3 or 4 years straight of 20 or 30% moves. It was absolutely insane. If you're in the idea that we are within an AI bubble that mirrors the dot-com bubble, then you should be expecting another 20% plus year. I don't think so. Reasonably, I don't think we're going to have another 20% plus year. I do think it's going to be bullish. We have the data to support that. I'm not going to go into all of that. That's for the paid side of our market research portal. But I think it's reasonable to expect that we're going to have another decent year, 20% plus, probably not. And once again, it all comes back to the dollar. The dollar raising, going to continue to have a headwind to stocks. And it's really going to shore up where we're going to be able to find a majority of our profits this year. And so that's kind of where I want to take this conversation now is 2024 was the year of you could really buy, I don't want to say anything, but there were a lot of opportunities in the market. You could have owned a lot of different sectors. You could have owned a lot of different market caps. It's very different than 2023 where Mag 7 really took control. In 2025, where the environment is a raising dollar, if you're expecting a continued bullish market, which we are, it's reasonable to expect that environment from 2024 where everything was breaking out, probably not going to continue. And we have a general roadmap of that right now. You can see that in December, your equal weighted S&P 500 really saw a lot of the market sell off, right? This was a historic breakdown in market breadth. Over the course of December, we saw nearly an 8% pullback in market breadth. Now, not everything got hit. A lot of the Mag 7 stocks held up reasonably well. A lot of the previous market leaders held up reasonably well. But this idea that everything damn near could be bought and it would make you some money was completely crushed in December. A lot of people got hurt owning shit stocks for shit reasons. Don't expect that to change. At least I don't in 2025. I do not know if the shotgun style of approach in the market is going to continue to work. I do know, though, that if EQAL, which is your equal weighted Russell 1000, we're looking for a reason to want to get long with size again. Now, if you're in TTI, you know that we haven't taken a lot of trades in the last 4 weeks. Through December, we saw a lot of weakness. We decided to play a lot more aggressive defense into January as well. I'm assuming the playbook is going to be the same. We're going to wait. We're going to wait for more confirmation that the market wants to find a floor and start to reverse. When we get enough of that data coming in, we will start buying again. But we really slowed down our buys in December because we saw the weakness come in. We're not going to buy the dip if there's no reason to buy the dip. We don't just discretionally buy the dip. We want a reason to buy it. EQAL is a reasonable chart to give us some of that data. If we bounce off the 48 area, this would be a patented BRB setup, right? A breakout retest bounce. This would be great for the overall market. Once again, this is your Russell 1000 equal weight. This constitutes roughly 93% of the total market cap, right? So if this starts to bounce here, we can reasonably assume that the broader market is going to bounce. And then we're looking at something like the intermediate trends need to be, worked on here. If you're in TTI, we talk about this all the time, but we look at stocks above, your short-term, intermediate, and long-term moving averages. You can use something like a 20-day, 50-day, 200-day as just a general idea of where a majority of the stocks in the S&P 500, for example, are trading. And for most of the year, we were trading north of the 50 and the 200-day and the 50-day, which represented strong intermediate and long-term trends. That's what we want to see in a bull market. But obviously, over the course of December, we saw broad-based market breadth breakdown, and that really did crush a majority of the S&P 500 stocks, at least on an intermediate basis. We're trading at 1 year lows here, right? 1 year lows. We're trading at sub 20% of the stocks in the S&P 500 now trading above their 50-day moving average. That's not great from an intermediate long-term standpoint. Now, the question then shifts, how do primary trends or long-term moving averages look? We are also trading near yearly lows, but we're still holding above the 50. So the question is this a pullback within a broader uptrend, which we've been in for the last 2 years, or is this the beginning of a bigger move? And it's a difficult question to answer. When we aggregate all of the data, it still suggests that we're within a pullback of a broader uptrend, but with the dollar breaking out here, potentially putting more pressure on stocks, that could change quickly. We do know that as long as intermediate term trends are down, which once again, I'll show you at least in the S&P 500, below 50 is not great, and sitting at 20 is absolutely not good. Big breakdown in December. As long as the majority of stocks in the S&P 500 are below their 50-day moving average, it's not reasonable to say that intermediate trends still look strong. They don't. They're being tested right now. If this continues to break down, along with a breakdown in the 200-day moving average, which does impact this idea of long-term trends, this primary trend, I think it's reasonable to expect that this might not be a pullback we want to buy at least yet, right? This might be the beginning of a bigger correction. I do want to point out that generally speaking, we do get a 10% correction, 1 or 2 per year on average. We did not get one in 2024. Is it reasonable to expect we get a 10% correction in the market this year? Yeah, I think we absolutely, it's reasonable to expect that we could. Could we potentially be trading through the beginning of it right now? Absolutely, we could. We just don't know yet. I do know, though, that right now, defense is probably more preferable than offense. That doesn't mean sell everything. That doesn't mean short everything. It just means reduce your open exposure, particularly in new positions, right? We're not opening a bunch of new positions, and we really want to be selective with what we buy. So let's actually go over and look at the scans here. This is a scan that we utilize once per week, at least officially, where we're looking at some of the strongest stocks in the market. Growth stocks, we have a slant for growth stocks here. This is kind of a play off of the CanSlim scan. We throw our technicals on top of it. And what it allows us to do is find higher beta growth stocks that are pressing into new highs. They have some fundamentals behind them that the market tends to like. They have the technicals that we tend to like. I'll tell you that a majority of the strongest stocks that we owned in 2024, your apps, a lot of your recent IPOs that absolutely ran like crazy, Shark Ninja, stuff like that, your Palantirs came from this list. So it's reasonable to expect that something on this scan over the next 4 weeks is going to show you a market leader at the end of 2025. You're going to look back at this and go, shit, I saw this in January. I wish I would have bought it and owned it, right? So not a bad place to start. What we're looking for here, though, is because the market has been pulling back, is this concept of relative strength, right? Market's pulling back. Let's look for stocks that are not pulling back or at least holding their own, right? They don't need to be necessarily breaking out into new highs. But this concept of relative strength gives us an opportunity to find the stocks that the market doesn't want to sell off for whatever reason, while the broader market does. That gives us a clue that when or if the market does catch a bid again, we do start to round out, this index does start to get bought back up, that these stocks should have a better chance of outperforming over the next 1 to 6 or 1 to 12 months. There's a couple here that I want to highlight that I like a lot. First one here is Bros, Dutch Bros. For those of you that were trading last year, this was a pretty good trade to have on your portfolio. We like this above 49.5. We were able to open this up. We like the gap up off of their earnings. This is called what we call a power earnings gap. Let's go ahead and throw a couple of these indicators on here. You can see what we're looking at here. We like the fact that it's trading north of an upward sloping 200-day moving average. We like that. The primary trend idea is important to us. We like the fact that it's trading north of a 50-day or 50 RSI, We're currently within a bullish momentum regime, meaning that as long as the RSI is trending above the 50 and below the 100, for the most part, buyers should be in control. Even when there's sell-offs, even when there's drawdowns, buyers tend to show up when they need to. We like that, particularly when we're buying stuff in a market sell-off. We want buyers to show up. We like the fact that it's held a range. Its previous kind of resistance area here at 49.5 was our trigger to get long. We like the fact that it's building a base above that trigger. For whatever reason, once again, the market's selling off, but Bros does not want to. We like it higher. The cool thing is even if you bought it at the 49.5 area, you have an opportunity here, particularly from an option standpoint, to add exposure on a new rebreak here. I like the new level, anywhere above $56. The fact that it's consolidated here for multiple weeks in a row gives options traders an opportunity to buy this at a discount, right? Because this has consolidated here for a couple weeks straight, the premiums and the contracts that we own right now have come down. Now, this is a free trade for us, so it doesn't matter that the premiums have come down. This is an opportunity to either add more or start a new position at a discount. If you would have bought Bros a couple of weeks ago, this thing would have been a lot more expensive than what it is right now at the exact same price point. So that's what we like to do in TTI. Let's find discounts on the options chain to really juice up the potential returns on a breakout here, which is what we like. So above $56 on a close, we like it up to 66 and then potentially 92.75. This is a higher beta name, 3.78 ADR. So if you're going out on the options chain, I don't want to go out to like the Februarys or Marches. Right now, we're going out to the June of 2025s. Once again, we're being selective with what we want to own. We really need to be convinced that the market wants to own these even in the face of a broad-based market breakdown. And we do think that Bros has a pretty good opportunity here. It's in the right sector. It's a consumer discretionary name. It's showing all of the right things from a technical standpoint that we like. And once again, if you're a fundamental or like fundamentals, this has the fundamentals to back it up. This is a CanSlim type name. Like Bros, above 56 for a new entry, $66 and then 92.75 over the next couple of months. The next one I want to go through, if we look through this, is TSM. I know right now there's a lot of hate for semiconductors. Semiconductors as an industry group have not done a lot since July. I understand, particularly with NVIDIA, people that have bought options contracts on those have really gotten crushed, particularly at NVIDIA, because it hasn't really done a whole lot. If you weren't early into some of the dips, you weren't able to turn those free, etc. But there are a bunch of semiconductors that don't look like NVIDIA, right? AVGO, MRVL, ALAB. These are market leaders. TSM is up there as well as one of those potential market leaders. We're going to go ahead and pull that up here. Let me make my case. You don't have to agree with me. That's totally fine, but that's what makes the market fun. All it is are a bunch of buyers and sellers disagreeing with each other, right? I want to own more TSM as it breaks above this potential horizontal box that it's been forming above 205. Last week, I actually already did open this up, so I'm in a position. I am slightly down in this. And this is another one of those trades that I like from an option standpoint because the implied volatility is not super juiced here. I'm looking at buying all-time high breakouts in lower implied volatility environments because we're able to buy calls without them being super expensive and without needing to hedge against potential implied volatility crush, right? In a lower IV environment, up into all-time highs, I really like to use those call options, and so that's what I did. I went out and bought a bunch of call options on TSM last week. I like this on a close above 205, which we technically got. I entered, but we've been consolidating here sideways since the middle of October. So once again, another one of these types of trades where if you're buying call options, the longer this thing trends sideways, the stronger it gets from a technical standpoint, at least for new entries, and the weaker it gets from an option standpoint if you're holding the contract. So if you're looking at a new position, the premium on this is just absolutely getting killed compared to what people might have bought back in October. So it represents a good discount, right? You can get these for 50, 60% off from just 2 months ago, and that's what we like to do in TTI. We like to buy discounts. Once again, we're trading north of an upward sloping 200-day moving average. That primary trend is very important for us, and we are within a bullish momentum regime going back to, I shouldn't circle it that far because it started back in August. So for the last 6 months, TSM, once again, bulls have been in control. Every time TSM starts to dip, it gets bought, right? So we like it. A continuation play off 205 price target here, 265 over the coming months. Once again, I played the Junes of 2025, so I want plenty of time, 6 months worth of expiration on this. I expect this to break out above 205. And before everybody wants to hate on semiconductors, because I understand semiconductors have not been the same trade they were over the last 2 years, we are slightly more bullish SMH than we have been in the past. I do think that we're coming up on a decision point, an inflection point within semiconductors here. You can draw whatever stupid chart pattern you want. Obviously, I think this is coiling here. And when volatility really gets tight, when the RSI really starts coiling around the 50, when price is riding the 200-day moving average, you tend to get an explosive resolution. Whether it's up or down, you can choose whichever one you want. But for me, we're trading in an upward sloping 200-day moving average, and the coil here, the consolidation, is at the top of a massive move. If you're a classical technical trader, you have to give edge to the bulls, resolution to the upside. So I do expect semiconductors to continue to break out. A little anecdotal evidence, I do think that if semis don't break out here, that this might be a potential topping pattern for the strongest industry group, kind of the flagship industry group of this bull market. For those of you that are looking for a reason to want to get short more this market, semiconductors resolving lower here, I think, is the catalyst, along with the rising dollar, to send this market lower. But we're not there yet, right? So of the scan, once again, I like Bros, I like TSM. I don't think this is the type of market environment to go out and own 30 plus positions. Some of you guys are out there owning 30, 40 positions at a time. As swing traders, don't do it. You got bailed out in 2024. You've probably felt the crush in December. We had the best year we ever had in 2024, but December was a sobering reminder that if the market wants to sell off everything, you're going to get crushed 30 different ways instead of potentially 5 to 10. Focus on what you own. Manage the risk appropriately. If you're trading options, flip those things free at 100% the way that we do inside of TTI. If you're trading shares, cover your entry as soon as you can and let these trends potentially continue to ride. I also really like Hood. I just don't think there's a playable setup there yet. I do think Bros is a reasonable buy as soon as we flip over 56, which we're right there. I do think TSM is a reasonable buy above 205, which we're right there at. And let's go ahead and click to page 2 because this is new. NVM. Not something I want. So those are the two that I like from this report in particular. If you're inside of TTI, Bros will be posted. TSM is already posted. If you're not inside of TTI and you like this type of content, you want to see exactly what we're trading, including entries, stops, and take profits, feel free to click on the link in the description below. Check out what we're about. We offer quarterly subscriptions. It's an awesome opportunity for you to get in and figure out exactly how to trade these markets through a technical standpoint. All right. I enjoy you guys. Thanks for hanging out with me on Thursday. Enjoy your lunch. I'll talk to you again soon.